everything bubble has just popped and the real estate market is crashing. Or at least, that's what the news would have you believe. But can you really blame them? I mean, they're just trying to get eyeballs on their content, just like me. But unlike them, I'm gonna be sharing with you in this video why I believe the real estate market is not crashing. I repeat, is not crashing. So if you would like to have a bit more to say about the current state of the real estate market and interest rates, the next time you're at a gathering and that one guy starts in again about how the
real estate market is crashing and it's gonna be way worse than 2008.
Well, sit down, grab some popcorn, smash the like button, and let's get into it. So first, let's address the question that's on everybody's minds. Why are home prices so high? Well, to tell you the truth, there are really only two main reasons that real estate has appreciated 30% in the last 2 years, taking us from an average home value of $322,000 at the start of 2020 to $422,000 right now in 2022. And the two reasons for this massive increase in home values is the housing shortage and inflation. First up, the housing shortage. And I know you've probably seen a lot of headlines out there and news articles talking about the housing shortage, but is it even true? Do we really have a housing shortage? Because when you go outside in your neighborhood, it probably looks like there's plenty of houses pretty much everywhere, right? Well, from everything I know, yes, it is true. As a whole, nationally, we just don't have enough homes to satisfy the demand. The National Association of Realtors even has a housing shortage tracker, so you can scout out the areas in the nation that have better supply than others. And the main driver of this housing shortfall has been the long-term decline in construction of single-family homes. And that decline has been exacerbated by an even larger decrease in the supply of entry-level single-family homes or starter homes. To put things in perspective for you, in the late 1970s, on average, we were building about 400,000 entry-level new single-family homes per year, which accounted for about 34% of all homes that were built during each year. But then rising interest rates led to a decrease in housing demand as housing overall became less affordable. And by the early 2000s, we went from building over 400,000 entry-level new homes per year to just 150,000 entry-level new homes each year. But following the crash in 2008, things just got even worse. Because as the housing market had its feet swept out from under it, people in general just stopped buying real estate. And that resulted in developers stopping building real estate. And that resulted in the 2010 era where we only built about on average 55,000 entry-level new homes each year. And in 2020, we only built 65,000 entry-level new homes that year. And that means we were building 84% less than we were building in the late 1970s. So in short, why do we have a housing shortage? Well, we've just been underbuilding for the last decade, while at the same time, the population of America has still been growing. And if you're at all familiar with economics, you'll know that if the supply of something is decreasing, but demand is still the same or increasing, then the price can only go one direction, up. And that's the current situation that we're in. We have a lot of people looking to buy a home, but just not enough homes to satisfy demand, which has resulted in this situation where most sellers are getting multiple offers from multiple buyers on the home that they're looking to sell. In fact, this is so common even that you can find articles online just outlining how much over asking price you should offer in order to buy a house in this market. But the housing shortage isn't the only thing keeping the real estate market prices so high. We also have the highest level of inflation that we've seen in the last 40 years. And this has affected pretty much every market, from the stock market, the bond market, the real estate market, the crypto market, and even alternative investments like NFTs, art, watches, and even cars. Pretty much the price of everything has been going up, which I'm sure you've noticed. But in some ways, that's not really surprising because in January of 2020 until October of 2021, the United States pumped $16 trillion with a T into the economy, which accounts for about 80% of the total US dollars in existence. Meaning that at the start of 2020, the United States economy had about $4 trillion in circulation versus now where we have about $20 trillion. And if you're pumping that much money into the economy and dropping the federal funds rate down to 0%, people and institutions are going to be flush with cash, and the prices of goods, services, and assets are going to increase. Now let's address the next major question. Why are interest rates going up, and why have we seen in the last 2 months alone mortgage rates jump from about 3% to over 5% on average? Well, as I just mentioned, back in 2020, the Federal Reserve dropped the federal funds rate down to 0% to try and keep the economy alive. And if you're unfamiliar with the federal funds rate or the Fed rate is, it's basically the interest rate that banks pay to each other to satisfy their cash on hand or cash reserve requirements. And as a result of this, many interest rates fell as well, and that's why you were seeing people getting 3% mortgage rates or even under 3%. And that means that a lot of homeowners in America were refinancing to get those really low rates. But with inflation up to 8.5% per the latest CPI data, the Fed is trying to step in to bring that inflation rate down. And one of the tools in their belt to fight inflation is the federal funds rate. Because if the Fed increases the federal funds rate, then lending and borrowing money as a whole becomes more expensive. And this decentivizes spending, which will hopefully help curb inflation and bring it down at least just a bit. So back in March, we saw good old Jerome Powell raise the Fed rate up 25 basis points, the first increase we had seen since 2020. And then again on May 4th, he increased it another 50 basis points. And this has resulted in mortgage rates jumping from that 3% rate to over 5%, which is the highest we've had since 2009. And there's even talk of mortgage rates increasing to 7 or even 8% by 2025. Although do keep in mind that nobody knows for sure what's going to happen in the future. If they did, they'd be a trillionaire. And now that interest rates are going up, how is this going to affect home prices? Because many people are expecting home prices to just drop as a result of these increased interest rates. And you would definitely be correct in thinking that higher interest rates is going to put negative pressure on home prices. Because nobody wants to pay a really high interest rate and a really high home price as well. But also realize we're not just going to see everybody stop buying homes just because interest rates are up. Regardless of what interest rates are doing, people are still going to be buying real estate. Even though every 1% increase in your mortgage rate, your buying power goes down by 11%. Even with this being true, people will still be buying real estate. And when you look at the last 3 years and see how much mortgage rates have gone up, it can seem pretty daunting. But when you zoom out and get some context and realize that in the 1980s, the interest rates were about 18% or higher, 5% doesn't seem so bad now, does it? And guess what? Back in the 1980s, people were still buying homes. You could probably talk to a parent or grandparent who bought a home at a 15% interest rate or higher. But I do expect that we're going to see these rate increases help pull the market down a bit, help it to cool off. And I'm not saying that the real estate market is actually going to fall or go down, but instead of seeing 30% appreciation in real estate values in 1 year, which we've seen in some hot market areas, maybe it'll just chill out and we'll go back down to the 3 to 5% appreciation year over year that we're used to in the real estate market. We're already seeing some homes sit on the market just a little bit longer, and we're not seeing quite as aggressive offers that we were seeing a couple months ago. So this is a good sign if you're looking to buy a home. But can rising interest rates really counteract the housing shortage that we have across America, which some estimates put at over 5 million homes? And the higher interest rates actually isn't helping the housing shortage at all. In fact, it may be exacerbating it. Because in 2020 and 2021, a lot of homeowners refinanced to get sub 3% interest rates on their home. And now that interest rates are way up, almost double, why would you sell your home and get a rate that is so much higher than the one you already have locked in? And that's going to cause a lot of homeowners to sit in their homes and not sell because they're trying to avoid those really high interest rates, which ultimately will lead to low supply of homes on the market. And the next big question I'm seeing a lot of people ask and wonder about, and that I've been asked personally, is whether we're going to see a real estate crash like we did in 2008. In my opinion, and I cannot stress enough that this is just my opinion, no, we won't. And I'm going to tell you why. The early 2000s real estate market was being pumped so full of bad loans that people really shouldn't have qualified for. Let me explain. Here's a quick rundown of what was happening. Many people back in that time period were getting what are called ninja loans. No income, no job or assets, aka people who couldn't afford a house were getting houses. And to make things worse, they were getting those loans on ARMs, or adjustable rate mortgages, which means that their mortgage rate wasn't set and it could go up or down depending on the market. And then those loans were all packaged together as CDOs, or collateralized debt obligations, and then sold on the securities market with a AAA rating, which is the highest rating a bond can receive. Basically, a AAA rating is saying that the underlying assets in that bond are rock solid, but they weren't. Those CDOs really should have gotten junk bond status. So eventually, as people's mortgage rates started to increase and people started defaulting on their loans, the whole thing collapsed. So do I see this happening again in 2022 or 2023? In my opinion, I don't think so. Because in the early 2000s, the real estate market and the lending market was the problem. Right now, we have such a housing shortage and so much pent-up demand for housing that I don't think we would see real estate prices fall by nearly that much. Not to say that we won't see a real estate correction in the future. In fact, I'm sure that we will at some point. I just don't don't think that we're gonna see real estate prices fall by 40 to 50% in the next 2 or 3 years like we did in 2008. A 5 to 10% correction I could definitely see happening at some point, but I don't think 50% is very likely. Now, what should you do? Whether you're a buyer or a seller, here's my advice. If you're a seller and you have a great interest rate, especially if it's below 3%, don't sell. Unless you have to sell because of a job transfer or some other reason, if I were you, I would just hold on to my really low interest rate and stay in my current home. But that's just because I don't like paying more interest than I absolutely have to. And if you're a buyer looking to get into this market, maybe looking to buy your first home, it can be discouraging seeing how high home prices are, especially with interest rates increasing. It's definitely a tough situation to be in, and I feel for you. But remember that time in the market always beats timing the market. If you have the stable income and the means to do so, go for it. Buy a house. You can always buy right now at those 5.25% interest rates and then refinance once they go down, which they will at some point. We just don't know when. But if you're trying to wait until the end of this year to see if interest rates drop, or maybe 2023, who knows what the interest rates will be at that point. They could go down, but they could also go up to 6 or 7%. And if you buy a home right now at 5.25%, but then the interest rates drop to 3% in 2023, you can always refinance to that lower rate. But if you wait until 2023 because you think interest rates are going to drop, well, then you're gonna be stuck getting that rate, whatever it is, which could be 6 or 7%. You won't have the option to get that 5% rate that you can get right now. Overall, think in long time horizons, 5 years or 10 years or more. If you're looking to buy a house and live in it for at least 5 years, don't let the price and interest rate affect you so much. Let me know your thoughts down below, and as always, thanks for watching.